Hey, if you own rental property, you're sitting on one of the best tax-saving vehicles in the country. But here's a problem. Most rental real estate owners are leaving thousands of dollars on the table every year because they're not claiming all the deductions they're entitled to. So what I'm going to do in this video is I'm going to walk you through 12 must-claim deductions every real estate investor should know about in 2025. We're going to be talking about mortgage interest, depreciation, travel, and even more lesser-known write-offs that could save you some serious money on this year's tax bill. So if you're tired of overpaying in taxes while your rental property sits there generating income, then stick around because these 12 tax deductions could seriously cut your tax liability in half. So let's dive in. All right, so what is the first one? Well, that's a basic one. Everyone should know this, your mortgage interest. If you have a mortgage on your rental property, the interest you pay is fully deductible. This is one of the biggest deductions that is available to landlords that they can claim, especially in the early years of a mortgage when most of your payment is going towards interest. Now, keep in mind, you can only deduct the interest portion of your mortgage payment, not the principal. In fact, you'll know this because your lender will send you a Form 1098 each year showing you exactly how much interest you paid during the year, and you got to keep that form. It's gold. It's at tax time. Now, if you have multiple rental properties, each mortgage interest deductions will add up quickly, and this is one of the easiest ways to reduce your taxable rental income. Okay, the second one is depreciation. Depreciation lets you recover the cost of your rental property over time, even though you're not actually spending money each year to maintain it. So here's how it works. The IRS says that residential real estate has a useful life of 27 and a half years. So if you take your property's cost basis minus the land value and you divide it by 27.5, that's how much you get to deduct every year against your rental income. So if you bought a rental property for $275,000 and the land was worth, $50K, so your building value then is $225,000. All you do is you divide it by 27.5 and you get about $8,182 in depreciation every year deduction that you can take against your rental income. That's an $8,000 deduction you get to claim every year without spending a dime. Now, with the 2025 bonus depreciation that we have now that's now permanent for a property placed in service after January 19th, you can accelerate this depreciation through what is termed a cost segregation study with bonus depreciation that saves you thousands in year one. Now, the other thing to be aware of, the third one is going to be repairs and maintenance. Now, I've cut a video on this explaining the difference. See, repairs keep your property in working condition and are fully deductible in the year in which you paid them, meaning fixing leaky faucets, patching holes in walls, painting, things like that. Now, the key distinction between an improvement, though, is that repairs restore your property to its previous condition, where improvements, like a new roof or a kitchen remodel, are depreciated and they're not deducted immediately. So what you want to be focusing on then as your rental real estate investor is how do I take and turn those expenses or make them into repairs and not look like an improvement. Now, be sure to catch my other video that I cut on this. You'll see a link in the show notes. Go down there, click on that video, and it'll take you to that video breaking this down for you. Okay, number 4 is pretty straightforward. That's your property taxes. The property taxes you pay on your rental are 100% tax deductible. So don't miss those. All right, number 5, insurance premiums. All the insurance premiums you pay for your rental property are going to be deductible. That includes your landlord insurance, liability insurance, flood insurance, mortgage insurance. So if you're paying $1,200 a year for your landlord insurance, that's $1,200 off your taxable income. Number 6 is going to be property management fees. So if you hire a property manager to handle your tenant screenings, collect rents, things like that, those expenses are deductible. Now, you can be your own property management company, right? You can create an entity. I talk about this in my other videos. You set up an LLC, you treat it as an S or a C corporation for tax purposes, and then your LLCs can pay your entity. And by doing that, that property management fee you're paying to your own entity is deductible to the LLC that's making the payment. This is a great way to lower your rental income that flows down onto your personal return. Okay, number 7. This is going to be utilities, right? Any utilities you have that you pay for your rental property, the water, the gas, the electric, internet, trash, you name it, they're all deductible. Now, this applies to multifamily, single family, anything that where you're paying the expense, you get to deduct that expense associated with those utilities. All right, number 8, advertising and marketing. Hey, have you thought about this? If you're advertising your property, right? If you're spending money to attract tenants, that is also a deductible expense. So any online listing fees that you have, those for rent signs that you put out there, if you pay someone to professionally take pictures of your property, or better yet, there's a tax strategy right there. Pay your kids to take photos of your property. The money you pay them, deductible to you, non-taxable to them because it's within their exemption amount. See, these types of strategies start to compound on themselves. What's creating this? The fact that you have rental real estate. So the thing about having rental real estate is you got to travel to it. So that's number 9, deducting your travel expenses. If you travel to your property, all right, to look at it, to make repairs, to meet tenants there, that is all a deductible expense for you, okay? So you take mileage on your vehicle. You reimburse yourself for your mileage deduction. Or maybe your property is 200 miles away, so you take a train or you take a plane to get there. That can be deductible. The hotel stay while you're visiting your property to meet with your tenants or to meet with a contractor, deductible. Rental cars, meals, parking, tolls, you name it. That's all a deductible expense. The key here in deducting travel is that the primary purpose of your trip must be business related. So if I'm flying across the country for a property tour and I spend 1 day of sightseeing, that's fine, as long as I can show that the majority of the trip was business related. All right? So make sure you're not missing out on that one. Now, the other thing to consider here too is, hey, where are you running your business? So deduction number 10 is going to be home office. If you manage your rental properties from a dedicated space in your home, you can deduct that home office expense. Now, here's some rules here around this. Number 1, you must use the space exclusively and regularly for your rental business. All right, and it must be your principal place of business for running this rental activity. Okay, that's very important as well. So how do you go about doing this? Well, you got to get with your CPA and they're going to show you how to calculate this. And then basically they're going to look at the amount of space you have in your home office, do a calculation on a square footage basis and come up with the amount that you can deduct from your taxes. Now, if you have any legal and professional fees, this is going to be number 11. Attorney's fees, accountant's fees, tax prep costs related to your rental property are going to be deductible. If you have to evict people, setting up an LLC, reviewing leases, tax returns, property inspections, all that becomes deductible against your rental income. And the last one I will leave you here is going to be the miscellaneous expenses, and there are dozens of other deductible expenses people often overlook, like HOIE fees, pest control, snow removal, cleaning services, licenses and registration, bookkeeping software costs, right? Legal forms, I already talked about that. Maybe you have continuing education. You're getting some trainings by you're going to seminars. That can be deductible as well, because that's going to help you in your real estate business. Bank fees and transactions, tenant screening costs. I mean, like I said, there's so many different things there that are available to the landlord. And so you want to make sure you're tracking all this, keeping good books and records, because all this starts to stack on itself. These are things that reduce your income, allow you to get a higher return on your investment. In fact, I'm going to give you a bonus tip here. If you're a rental real estate investor, another way in which you can help reduce your taxable income is make sure your tax preparer is taking advantage of the 20% QBI deduction. All right, that is qualified business income deduction. So if your rental property qualifies as a trade or business under the safe harbor rules, you can deduct 20% of your net rental income. That means it's not even taxed to you. And this is permanent under the new tax law. So that means if your rental property generated, I don't know, say $50,000 in income after expenses, then you can deduct an additional $10K. Okay, that's 20% of that $50K. I mean, it's just amazing how many deductions are there for rental real estate owners where you can wipe out your income if you understand where these things lie and how to take advantage of them. Now, if you want to learn more, I would like to invite you to our one-day tax and asset protection workshop for real estate investors, where we talk about proper structuring to set up your business the right way. And then we show you how, after you got the structure in place, to use the tax code to really start driving down your taxable income, producing, in some cases, paper losses that you can then use to offset your W-2 income. It's getting this type of information that I think is critical for all landlords if they want to truly harness the tax benefits that come from being a real estate investor. Listen, if you got questions, drop them in the comments. I answer all of these personally. And if you have any ideas for upcoming videos, be sure to put that in there as well. I'll just say this. Hey, until next time, protect your assets and maximize your deductions.